Welcome to The Explainer. Today, we're going to tackle a massive question, one that's right at the heart of finance. How in the world do you put a price tag on an entire business? It's a number that can make or break fortunes. So, let's figure out how it's actually done.
It really is a fascinating puzzle, isn't it? I mean, anytime a company gets bought or sold or decides to go public on the stock market, someone somewhere has to come up with a number. But where does that number even come from? Well, it's kind of a blend of art and science, and it all boils down to two fundamental ways of looking at it.
To make this super simple, let's just think about valuing a house. You've got two main options, right? First, you could look at the bricks and mortar, the physical stuff, what it actually owns. Or second, you could look at its potential to generate rental income, what it can earn. Well, that exact same logic applies when you're valuing a business. It's either about what it has or what it can do.
Okay, so before we jump into the how, let's quickly cover the why. A formal valuation like this usually gets triggered during some of the absolute biggest moments in a company's life.
A valuation is absolutely critical during something like a takeover bid, where the buyer has to figure out the maximum price they're willing to pay. It's also the key number for setting the initial share price for an IPO. But it's not just for big public companies. Nope. Private sales between individuals, mergers between two firms, and even tax calculations when a shareholder dies, they all need a formal valuation.
All right, let's dig into our first method, the asset approach. This is that bricks and mortar view we were just talking about. It really is all about one simple question: what is all the company's stuff actually worth?
The core concept here is called net asset value, and the idea is beautiful in its simplicity. Assets minus liabilities equals value. You take everything the company owns, its factories, cash in the bank, inventory, you name it, and you subtract everything it owes. What's left over? Well, that gives you a baseline valuation for the company.
But of course, even this simple approach has layers. When we say value the assets, what do we really mean? Do you use the balance sheet value, what was originally paid for them years ago? Or the net realizable value, what you could get if you sold them today? Or maybe the replacement value, what it would cost to buy them all over again from scratch? Each one of those will give you a different answer.
Now, for the second, and I'd say often more popular method, the income approach. So if the asset approach was all about the bricks and mortar, this one is all about that rental income. We're totally shifting our focus from what the company has to what it can earn. Probably the most common tool you'll see here is the price to earnings, or PE ratio. The idea is actually wonderfully simple. You look at a company's profit, and then you multiply it by a number that kind of reflects how the market is feeling about it. A really high PE ratio, for example, often means investors are expecting some serious growth in the future. Its biggest advantage is just how simple it is.
So the whole thing boils down to this formula. Let's say a company earns $2 per share, and other similar companies are trading at a PE ratio of, say, 15. Well, you might value that share at $30. You're basically saying the company is worth 15 times its annual earnings. Simple as that.
But hang on, what if you don't really care about some abstract earnings number? What if you, as an investor, only care about the actual, real cash that lands in your pocket? Well, that's where this model comes in. It says the true value of a share is just the sum of all the future dividends you expect to get from it. But since a dollar tomorrow is worth less than a dollar today, we have to discount those future payments to figure out what they're all worth right now.
And this just brilliantly shows the philosophical shift. The PE ratio looks at the total profit, but the dividend valuation model basically says, hey, I don't care what you earn if you just keep it all stashed inside the company. It makes the argument that value is only really created for a shareholder when that cash is actually paid out to them.
And finally, we have the heavyweight champion of valuation, discounted cash flow, or DCF. This is what you see used a lot in big takeovers. Here, a buyer tries to forecast all the future cash the business is going to generate. And just like with the dividend model, they discount all those flows back to find a single value for today. That final number tells them the absolute maximum price they should even think about paying.
Okay, so we've looked at the tools in the toolbox. But now we have to ask a much bigger, much more profound question. We've been trying this whole time to find a company's true value. But what if the price we already see on the stock market is the true value?
This brings us to something called the efficient market hypothesis. Now, this is a really powerful and pretty controversial theory in finance. What it says is that at any given moment, a stock's price already reflects every single piece of available information about it. And if that's true, then the price you see, well, that is the fair price. There's nothing else to find. Now, this theory actually comes in 3 different flavors, and each one gets a little stronger. First, you've got the weak form, which says you can't predict the future just by looking at old price charts. Then there's the semi-strong form, which argues the price reflects all publicly available info. So by the time you read about it in the news, it's already baked into the price. And finally, you have the strong form, which makes this incredible claim, that the price reflects all information, even private insider knowledge.
The implications of this are just huge. If markets really are efficient, it doesn't really matter when a company issues new shares, because the price is always fair. It also means that trying to trick investors with clever accounting is basically pointless. The market's going to see right through it. The price you see today, it already accounts for the value of all the company's future plans. So this leads to a pretty mind-bending question, right? If the efficient market hypothesis is actually correct, is this whole search for true value just a fascinating academic exercise? Is it a fool's errand? Could it be that the market price, right this very second, is the only number that truly matters? It's a question that divides the entire world of finance, and it's a great place to leave you thinking. Thanks for joining The Explainer.